Welcome to the Organized Investor PodCLASS with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant, and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Welcome back, students, to what is our 19th podcast and the 13th in a series on the subject of organizing your investments. This is the fourth segment of the deposition of Jerry Goodman, who is making the case that it's possible to improve someone's long-term financial future. We took a recess after the last podcast when we questioned Jerry about his tactic of continually harping on the dividend growth strategy because it took 6 months for him to embrace it, and he thinks that there are other slow learners out there like him. He explained that a bear market is a decline of at least 20% in the market from the most recent highs, and a market correction is a decline between 10% and 20%. So on that subject, we discussed his first of two examples of what he refers to as bargain opportunities during a market downturn. And he's going to explain today the second one in this episode. This is Megan Hubbard, and with us is my dad, Jerry Goodman. And since we're talking about opportunities, we're glad to have the opportunity to share some valuable information today, and that you have the opportunity to learn from it. I had the opportunity to teach first grade at Christian Academy of Knoxville, and Dad's had the opportunity to take ballroom dancing for an entire month. How did that go?
Well, we actually flipped over to line dancing after a couple of weeks at ballroom dancing. That was more fun.
Oh my goodness, I can't. I would pay money for video footage of that.
Country music and line dancing. It was great. It's actually a lot of fun, particularly if you go someplace where they had the free buffet right before the music started.
Oh, I don't know what goes together better, buffet and line dancing. It's just, wow.
Well, and it needed to be a place that had one of those big, like, dead trees in the middle of the dance floor that you danced around the big tree.
Oh my goodness.
Those were the days.
I'm sad I missed it.
Yep.
Well, I had the opportunity to get a master's degree in curriculum and instruction. Probably not as fun as the buffet and the ball dancing and the line dancing, but for our discovery process, I'll also have the opportunity to be the question asker. I'm literally counting the ers on my finger because if you've been listening to us, you know there are 7 ers at the end of asker. Dad had the opportunity to have over 40 years of experience in the financial services industry. So for this discovery process, he has the opportunity to be disposed. Oh, no, sorry, not disposed. I'm just making sure you're awake. Deposed with some tough questions. We aren't going to get rid of him. We're just going to ask him tough questions.
At least yet. Okay.
Well, yeah, we'll see how you do. And he also has the opportunity to take on the role of the deponent, also known as the question answerer. Hopefully our listeners at this point are now counting my ers.
Good grief, Megan. That was like the longest sentence, ever that you just went through. So congrats for not messing that up.
I love a good run-on sentence.
Mm-hmm.
Well, once again, hear ye, no need to rise because court is still not in session. And the matter before the PodCLASS involves organizing your investments and is it possible to materially improve one's long-term financial future? So, Mr. Dad, you're still under oath from the deposition that started way back in PodCLASS number 16. So we don't need that Bible your hand is resting on.
Hey, I don't know if you realize this or not, but my Bible has Gideon written on the cover. Do you know that? That means that I've been in a motel and I've stolen the Bible. How bad am I?
Well, they want you to take those. That's why they're there.
I guess. But anyway, and I was sure I was going to get sworn in again, but that's fine. I'll still tell the truth and the whole truth, even though my oath is about to expire. I'll do the best I can.
Now, there's a chance that someone has just joined us and has no idea what we're doing here or why we're even talking. So,
well, actually, Megan, they may have listened to every other PodCLASS we've done and still know what we're talking about.
Well, that's a good point. So can you give the the listeners here a super fast update of everything we've ever said?
Everything might be kind of tough, but I'll give it a try. And just for the fun of it, let me see if I can squeeze it all into just one sentence, kind of like you did a second ago. Let's give this a try. But here goes.
This should be interesting.
Here goes. And tell me if this is a correct sentence or a run-on, okay? So I'll say it rather slowly because I know you're a first grade teacher, you weren't second grade, so you may take a second to digest this. Here we go. We feel our dividend growth strategy of investing in companies with a history of growing dividends, outperformance, and lower volatility is the most consistently effective way to improve our clients' long-term financial lives. And the fact it took me 6 months to realize this is why we continue to harp on it so that our listeners will realize that as well.
That was also a mouthful, but I am not 100% that it was a correct statement.
Oh, well, it hurts. Anyway.
Well, I'd need to actually read it a couple of times to know for sure. But you did jam it all into what may be a single statement. I'll give you props for that.
Well, there's actually some other things we're also harping on, but until somebody realizes seriously just how good this dividend growth strategy is, everything else we kind of have to say is really kind of irrelevant or irreverent or something.
Well, I just realized your one sentence summary, it actually didn't include the evidence you posted on the website.
Oh, well, yeah, that's true, but that's way too many words and not enough commas. So I'll go through these very quickly. Exhibit A, it's a research list from Wells Fargo called the Diversified Stock Income Plan. We call it DSIP or DSIP for short because the name's too long. And that has a 30-year track record of 12% per year versus the S&P index, which has been about 9.6% a year. And oh, by the way, the DSIP list has less volatility. It moves up and down less than a lot of other things.
Well, and DSIP, just to clarify, DSIP is a dividend growth strategy, correct?
Yes, it is. And Exhibit D on our website, this is a Ned Davis research report, which shows the outperformance of this same kind of dividend growth strategy over an even longer period of time than 30 years.
And let the record show that exhibits A and B are both on the investments page of the website, theorganizedinvestor.com.
And let the record show Exhibit C is basically the PodCLASSes 11 and 12 that where we were explaining how we have 84 advisory accounts that we've managed for at least 5 years. And the net rate of return after any kind of fees or expenses for those 84 accounts has been 14.06% per year. And that goes through end of January 2024. So that is, what is that? That is equivalent to an increase of 92% over a 5-year period, which it's not a double in value, but it's pretty close. We've also got Exhibit D, which we talked about that's FOMO, the fear of missing out, and it covers the fear that an investor might miss out on the next Apple or Tesla or NVIDIA stock, whatever that is. And then we have Exhibit E, which covers 10 things you need to know about bear markets, and we talked about that in the last podcast.
I'm relieved you were able to harp on that one more times and get it out of your system. So in the last podcast, you described what occurred when the stock market got clobbered, thanks to COVID back in 2020, our favorite, pandemic to remember, and how that was what you referred to as a bargain opportunity, if you will.
It was, and the dividend growth stocks in the accounts had dropped really much, much less in value than a lot of other areas. Compared to, say, airlines, cruise lines, restaurants, casinos, hotels, theme parks. Basically, it was anything, let's just kind of sum it up. It was hospitality, travel related, air travel related, airline industry related, that sort of thing. So that gave us an opportunity to reallocate some of that money in the stocks that had dropped just a little bit into some of these stocks that had dropped a whole lot.
So where did the term bargain opportunity come from?
You ever heard the expression, you have to name the baby before you get to take the baby home from the hospital? You ever heard that? I basically had to make it up. And as the name implies, during a time like COVID, just for example, it really was an opportunity to get some great bargains. Things were on sale a lot.
And you said that every client you approached with this idea wanted to participate in it, with the exception of 3. Is that correct?
Best I can remember. And which was fine. I said this in the last podcast. I wasn't trying to talk anybody into this because our core strategy, kind of you dance with who brought you, would be this dividend growth strategy. But this was something we saw as a great opportunity, and only 3 people decided no, they didn't want to, which is fine.
And for the clients who did this, they had about 1% in 48 dividend growth stocks and 1% in 48 COVID affected stocks. So the account was about a 50-50 split.
Pretty much. So if you just put this in simple terms, let's say an account was a $100,000 account. So after we did this reallocation, they had $1,000 $1,000 in 96 different companies. So it was kind of like a little mini mutual fund, but with much more control and much less expensive than a mutual fund.
So can you share with us how you actually do this and what is the cost to do this?
Well, in the earlier pod classes, we explained that these are advisory accounts that allow us to manage the assets on, we're going to call it a discretionary basis, for a flat single fee that is probably actually lower than some advisory fee that your advisor might be charging you. Okay, that's kind of where this starts.
How do you know that?
Well, we actually know that because there are about 15,000 advisors that are affiliated with our clearing firm, which is Wells Fargo Clearing Corporation. And for those 15,000 advisors there, the advisory fee that they charge is on average about a quarter of a percentage point more than what we charge.
Is it true that the advisor actually decides on the advisory fee to charge you?
Usually. And we decided to charge less because we want to be more reasonable with what our clients are paying, okay? And managing this on a discretionary basis, it allows us to much more quickly adjust almost 200 accounts without having to track down 200 clients before we do something.
So you said this ended up kind of being the perfect bargain opportunity, if you will, and it was very profitable. But can you remind us, again, why you don't care to share some of the statistics about all of that?
The issue is that every account is different. It involved thousands of individual transactions that involved tens of millions of dollars over hundreds of different accounts. And basically the stocks, they weren't all bought or sold on the same day. So it's a little hard to kind of summarize something like that and what's an accurate kind of fair way to do that. It's hard. It's hard to do.
But you can say it turned out well.
Well, visualize the fact that we're buying stocks, some of which had dropped as much as 75% in value. So even if you don't buy them at the very bottom, and even if you don't get out of them at the very top, and they don't go out of business too, let's just throw that in because there was a lot of question about some of this. At some future point in time, you're going to make a lot of money off doing something like this.
And you said that none of them went bankrupt.
That's true. And there was a few that we kind of crossed our fingers on, but everything survived. Some made more money than others, but overall, it was a lot of fun because everybody made a lot of money. And, and we actually shared with everybody that, something on this list might go bankrupt, but it was so diversified that even if one or two companies out of 100 were actually to have a financial problem, it was mathematically kind of irrelevant.
So this bargain opportunity happened back in 2020. So why did you first bring this up in podcast number 18? I would have thought you'd want to brag about this, because it sounds like it worked out very well, so that I would have thought you would have mentioned it earlier, I guess is what I'm trying to say.
Well, I struggle with this, and it really concerns me. In the last podcast I said this, it concerns me because when I tell a story like this, the last thing I want is for somebody to think that this event, this bargain opportunity had something to do with me, and it doesn't, okay? This COVID opportunity that popped up, it hopefully will never happen again. It wasn't predictable before it happened. Regardless of what somebody tells you, the next bargain opportunity is not going to be predictable either. It's going to show up and it'll be a completely different event, whatever that is going to be. What we don't know yet.
So you don't want to give people the impression that you have some ability to find a crisis every year that you can't count, that you're going to be able to count on, I guess I should say.
Yeah, I mean, it would be nice to have that kind of control, but I don't think we do. What we can control is what we do with a bargain opportunity when they do pop up, okay? The fact that we're normally invested in higher quality common stocks that don't drop as much as other parts of the market, I can give you really an option to sell something that may not have dropped much and buy something that has dropped a lot. That's really what this is all about.
So would you say the DSIP list would be a good example?
It's a great example. And as a reminder, this DSIP list, this is a Wells Fargo research list. It's probably, the flagship list from Wells Fargo. It is a dividend growth strategy. And the return just off that list has been 12% per year, going way back 30 years to November of 1993. Now, I think it was PodCLASS 15 that we talked about the great financial crisis and just how much everything went down at that point over the course of an 18-month period. It was terrible.
So just so that our listeners know, the DSIP list summary is on the investments page of our website, theorganizedinvestor.com. And you want them to see the one that's dated the fourth quarter of 2017, correct?
Right. And we put it there. We put it specifically on the website because the reason that one's there, it's the quarter of 2017. It includes the performance of the DSIP list for the year 2008, which was smack dab in the middle of the great financial crisis. So during that one calendar year of 2008, if you look at that particular report on our website, you'll notice the DSIP list dropped 24.5% in that 12-month period.
And that's a good thing.
Well, it doesn't sound so great, but during that same period, the S&P 500 fell 37% during the exact same period. So 2008, the S&P dropped 51% more than the DSIP list.
You're right. So a 24% drop is better than a 37% drop. I'm not understanding.
Yeah.
Okay.
Yeah, pretty simple. And so while you're on the subject of, say, a drop in value, don't forget the mathematics of this, of why you want to avoid the losses. So let's say you have an investment that loses 50% in value. Let's say a $100 investment drops to 50. How much of an increase does it have to get back up to 100? Okay, it's not a 50% increase. If now it has to double in value to go from 50 back up to 100. That's why you really try to avoid the drops in value if you can.
Okay, so essentially what I hear you saying is that you need 100% increase to get that $50 of investment back to $100.
Mm-hmm. And the fact that the DSIP list dropped much less than the S&P, say back in 2008, and the fact that its long-term volatility is generally much less than the market overall, is because these investors in these kind of stocks, they're much more loyal to these types of companies. So this lower volatility, it's going to allow us to take advantage of some of these, let's just say the next bargain opportunity, whatever it is and whenever it happens to pop up.
You're listening to an Organized Investor PodCLASS, which makes up our College of Knowledge. Your hosts are Megan Hubbard and her favorite father, Jerry Goodman. You'll benefit most by listening to at least 12 PodCLASSes. And the best way to be reminded is to subscribe on your favorite podcast platform.
So you said in the last PodCLASS there were 2 bargain opportunities, and since COVID was the first one, we're all wondering, what's the second one?
Well, here we go. Let's get to this one. And I've said many times, all of these bargain opportunities, they are random. And they're unpredictable. There's never going to be, well, there shouldn't be. I would be surprised if 2 of them are even similar, much less alike. And let me just add, I wouldn't sit around waiting on one of these things to occur, okay? It's kind of like waiting on an earthquake or a volcano to happen. I mean, yeah, eventually it will, but it may be a long time down the road.
So did this one happen in 2023?
It did. And it wasn't as traumatic. It wasn't as widespread as COVID or, say, the great financial crisis or even the tech bubble back in 2000. But it was an opportunity to make a fair amount of money and do it pretty quickly. So here's how this one worked. It was March 10th of 2023.
That's your anniversary, by the way.
Oh, it is. It is, although same day. And by the way, on next March 10th, some of the listeners are happy to send me some cookies or something. That'd be great to celebrate. But a relatively large regional bank in March 10th of 2023 named Silicon Valley Bank went into bankruptcy. And that was really, it doesn't really matter why, but ultimately it was because the sharp increase of interest rates that created this liquidity crisis at the bank. I mean, that's what triggered all of that.
So was that only one bank that failed, or were there more?
There was several. I mean, there was a Signature Bank, there was First Republic Bank. I mean, there might have been a few more, but those are the 3 big ones: Silicon Valley Bank, Signature, and First Republic. And as you would expect, you had a lot of regional banks that dropped very sharply in price over the course of a month or so. And it was simply out of fear that, gee, what if this bank or that bank were also to fail? I mean, it really kind of ran a lot of fear through the market.
So mainly this was just involving like regional banks and not the whole market, correct?
Right. But some of these regional banks are actually pretty good. So as a result, the dividend growth stocks in these advisory accounts, they really weren't particularly affected by any of this news, unless maybe one of them happened to be a regional bank. And I don't recall that even any of them were. But when we reviewed the research comments from Wells Fargo and a number of other firms, there was this feeling that, hey, this is not going to be some widespread industry issue that's going to involve all these regional banks. It didn't appear that was going to be the case. It was kind of isolated to these 3 or 4 banks that had gone under.
So basically, you're saying the expectation was it would be isolated to a small number of regional banks and not the industry as a whole.
Mm-hmm. That was kind of what the consensus was. So once again, I did what we did during COVID. I start off, I pull off a research list of all the regional banks that we had an opinion on and sorted them by price. So again, the ones at the top are the ones that had dropped the most, and the ones at the bottom are the ones that had dropped the least, which just the way we sorted it. And like we did with the COVID stocks, we considered what the analysts said. Did he have a good opinion or a bad opinion? What was their price target? If the stock's trading at 10, what do they think it could go to? If it could go to 20, 30, whatever, to try to identify the ones that had good upside potential, and not to have, some extreme level of risk along with it.
So did you do the same thing as the COVID stocks where you actually purchased a number of them?
Mm-hmm. We try to spread this around. So we basically we repositioned some of the money, from the dividend growth stocks that hadn't fallen very much, and we basically bought about 1% of each in each account for 13 different banks. So it wasn't even half the portfolio, but let's say $100,000 account. We bought $1,000 of Regions Bank. We bought $1,000 of First Horizon, which used to be First Tennessee, $1,000 of Pinnacle Financial Partners, $1,000 of Truist, and so forth. So it totaled out 13 banks times $1,000 each for a total of $1,000 each. So it's $13,000 with the whole investment.
And don't banks actually pay dividends as well?
Yeah, and really, what was kind of cool about this was every one of these paid a nice dividend. So it really wasn't that much different than the dividend growth strategy that we try to use as a core strategy. Okay, the difference was that the prices we paid for some of these was off a huge amount from the high, which made it, what we're going to call it again, a bargain opportunity to hop in and buy some great companies at a real low price. And guess what? We're getting some dividends along the way.
So I'm guessing it's also safe to assume that you made some money doing this.
Yep, and I'm not going to try to summarize all 13 banks, but I'll just give you an example of one of them that our analysts they liked it. I guess I would say they liked this one the most. And it was a savings and loan. I think they're out of Phoenix. It was called Western Alliance, just as an example. Now, this is a very large regional bank in Phoenix, Arizona. It trades under the ticker symbol WAL. And if you just read about the bank, I didn't know much about them. They had been like the savings and loan in their sector or their sector of the market, like Bank of the Year, Savings and Loan of the Year for a number of years. So it's a very well-run bank. It just had gotten caught in this financial squeeze because of the rise in interest rate. That's really why they really liked it.
So some of the banks that you bought were not from around here, like not in our general East Tennessee vicinity.
Right. I mean, some of them I mentioned, like Regions and Pinnacle and Truist is kind of a Southeast bank, but many of them were from the Southeast, but not all of them. And basically on March the 3rd, 2023, now this was a week before, I'll give you an example, the week before Silicon Valley Bank collapsed. Western Alliance, which I was saying that's kind of one of their favorite banks, that stock was trading at $75 per share. 10 days later, after Silicon Banks had its problem and these other banks popped up too, 10 days later, that stock traded as low as $7.46, okay, a share, which means it traded as much as 90% in value from 10 days earlier. That's a big drop. Now, since then, basically for the first half of 2024, it's been trading in the $60 range. So it went from 75 down to around 7, let's say, just briefly, and now it's back up in the $60 range. So
that didn't take very long.
No, I mean it didn't. It was very quick. I mean it took, I don't know, to get back up in the 60s. It probably took 6 to 9 months, maybe. And while the other 12 banks, they didn't drop quite as much as that one, but this is all an example of a bargain opportunity that sometimes these things don't hang around very often, and if you're not paying attention, you can miss out on some of these things. Now, we're talking about let the record show this or that. We didn't buy Western Alliance at $7 a share, and we didn't sell some of it. We sold a lot of it in the 60s, but not maybe every share of it. So for everything we sold, say as of May of 2024, I calculated this out. Either we had sold it or we still owned it. The gain off that stock was about 80%. and we'd held it for about 176 days. So that was just my little calculation to give you one sense of how one little stock like that can, it's only a small part of the whole portfolio, but that's a sort of thing that you can trip across if you just pay attention and try to, have some money that you can reallocate, if you will, into something that's just dropped a lot in price.
So Western Alliance was kind of like making a nice return on the NVIDIA that everyone has been talking about, right?
Yeah, it's a great comparison. And these bargain opportunities, they're easier to find, than some once in a decade company like NVIDIA or Tesla, these companies that everybody would like to own. But usually after they've run up a lot in price, you think, well, do I really want to buy them now? So again, you just have to be paying attention to what's happening around in the market.
So did you make money from all 13 banks?
Yeah, we did. And again, as usual, some of these are going to be more profitable than others, because some of them just drop more in price. But it's another example of being able to take advantage of bargain opportunities when your core holdings, like these dividend growth stocks, when they're much less volatile. Like I used the example in the prior PodCLASS talking about Smucker's jelly. I mean, during COVID, and you understand this, why would Smucker's jelly go down in price just because of COVID? I mean, people are probably home, putting more Smucker's jelly on a biscuit because they're home and they can't go anywhere.
I've definitely put some Smucker's jelly on lots of biscuits during COVID, probably way too many.
Yep.
Well, so the dividend growth strategy is your main course. And, this bargain opportunity with the banks was, serving of a dessert, if you will. It was like a little extra treat.
It is. I love treats. Now, the jokester in me would say, comparing dinner and dessert would be kind of in bad taste. But
ha ha ha!
Isn't that funny? But the point is, dividend growth is what drives our core performance. And it's what we feel is the best approach to improving someone's financial future. And if we get an occasional bargain opportunity that pops up that makes sense, that's fine. We're going to take it. And we try to do it in a way that we're not taking a massive amount of volatility, because we try to spread it around as much as we can and not have an inordinate amount of money in just any one stock.
So what's going to be the next bargain opportunity?
I sure wish I knew. But really, who knows? It's all you have to do is turn on the news and you'll see lots of issues in the making, lots of things that get you kind of uncomfortable. So once again, these opportunities, they're not predictable. They're not recurring. They're not even guaranteed to work. But our experience has been when you can buy, a small percentage of a number of well-established companies that have experienced, what should be kind of some temporary drop, you're probably going to do pretty well and make some money off of this.
So do you have any other words of wisdom?
Oh, I'm just wisdom out today. Look, we don't consider an upside potential of less than 20% to be much of a bargain opportunity, okay? And really don't pay much attention to that unless the upside is, say, in the 40+% range, okay? That's because, when you get these 5 and 10% moves in price, I mean, they're very common. And I hate to refer to them as chump change, but they really don't qualify in my definition of what's called a bargain opportunity, okay? That's really just kind of how we view this.
So this is the fourth part of your deposition about what you're harping on and why. And one more time, who are you harping on?
Our first harp on group is someone who is obviously not yet a client, but who probably should be. The other group that can be, let's call them the families of our current client, someone who already is working with us. It could be their brother, sister, but it's usually their children. And that is because, first off, they need to understand how we're managing their future inheritance. I mean, that's just be quite frank about it. And all of these ideas that we're talking about, it may actually help the family with their own investments. And we're talking about right now, not some 20 years down the road when they're going to inherit this money. They have their own money that may be benefited by this as well.
Okay, so we're getting ready to take a recess. Is there anything else you would like to cover before we do that?
Oh, yes. Let's not forget that these rates of return we shared are for informational purposes, and the past performance is no guarantee of future results. You might have heard that before. And the returns of each of these are for our clients' accounts. They're based upon the client's individual circumstances, such as when they started the account or what their investment objectives were, all of those sorts of fun things.
Are you done?
Almost. The rates of return for our advisory accounts, they're compiled from a month-end performance report for each of those 190 accounts respectively. And it's like way too much information to try to put on our website in any kind of understandable way. So however We do have a lot of boring documentation we're happy to share with somebody if they're brave enough to sit down and let us go through it with them, if they want to see it.
I kind of feel like a funny joke would be to like print that off and wrap it up and give it to somebody as a Christmas gift. Maybe I'll do that to Meredith, my sister.
It needs a big bow on it.
A giant bow. Anyways, thanks for only telling one pun today. I'm proud of you. That was good.
Hey, Megan, if you spell pun backwards, it spells N-U-P, which is the saying would go, that's a nup out of you.
That is enough out of you. Let's move on. Listeners, please feel free to contact us with any questions you may have. And also be sure to follow us on social media, such as YouTube, LinkedIn, X, otherwise known as Twitter, and save us to your favorite PodCLASS player to receive reminders of future episodes. We have more to share, which means you have more to learn. So join us next time. And as always, thanks for listening. And this PodCLASS is dismissed, recessed, and adjourned until next time.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.